Hi, my name is Susanne Matern and welcome to our new series Structured Finance Conversations. I'm joined today by Matthias Neugebauer from Fitch's EMEA Structured Credit team. Today we are going to have a brief conversation about the CLO market and the rating trends. So Matthias, we have seen the inflation and interest rate cycle turn with 2 cuts already from the ECB. So we can take stock of how the CLOs have performed during that higher interest rate period, and they have performed again very well. So potentially we would have expected higher defaults when we started that cycle. Why is it the case that CLOs have again fared that well?
Yeah, it was certainly a surprise. They've performed well despite a substantial increase in financing costs on the underlying corporates, more than 2 times the borrowing costs in 22-23 compared to 21. So certainly my expectation would have been different too. But there were 2 reasons why they performed well. One, during the low rate environment after the GFC and before COVID, borrowers increased leverage, but they never really maxed out the interest coverage ratio. So interest coverage ratios were relatively healthy at the start of the rising cycle, let's put it this way, at 3.5 to 4 times. And that helped borrowers to absorb the increase in the index, Euribor, but then also for refinancing the margin. The second thing is, turns out that our borrowers had good pricing power. So they were able to pass the cost increases on to their customers and therefore maintain EBITDA margins. And those 2 factors together basically meant that we didn't see the performance deterioration that we expected at the beginning of 22. Now that's to say defaults have increased, so they came from so they're now running at about 4%, and that's also our forecast for this year and next year from a very low base, because the years in between COVID and the financial crisis were characterized by very low default rates, certainly towards the end of that 10-year cycle, near zero. So there's a marked increase, but really it's at the long-term average where we see it now. And that's also our forecast for the next 2 years, or for this year and for next year, unchanged from the beginning of the year. Half of those will be defaults that come from distressed debt exchanges. That has become more common. So those are basically extension or maturity extension restructurings out of court, where let's say there's a little more cursive language used by the issuer to make the syndicate agree to that, and that would be classified as a distressed debt exchange and considered a default event. So that's half of the defaults that we're forecasting, we believe will be DDEs.
It sounds very benign. So are there any areas of concerns in CLOs?
There are. I mean, we had 2 years, 22 and 23, where we hardly have seen any resets and refis. That's become the normal course of action for CLO managers when the deals reach a certain point to reset and refi. So they couldn't do that because the cost of financing had increased also on the CLO side, or wouldn't do that, let's put it this way, because obviously they would have locked in a higher cost of capital. So we didn't see any resets, refis. As a result of that, we have a lot more deals out of or past their reinvestment end date. But that's to say they don't stop reinvesting. So they can reinvest unscheduled proceeds, and they do. Managers have all the incentives to keep those deals with an AUM as high as possible. They continue buying assets. So it's a combination of partial deleveraging on those deals, but also buying assets. And because the life test is ticking down, they're buying shorter and shorter assets. So while deals in the reinvestment period have hardly any maturities in 25 and 26, the deals out of reinvestment, those by, say, kind of 2 years out of reinvestment, have now 20% on average, 26 maturities. Now, as I said, they are partially deleveraging. That builds credit enhancement and helps the investment grade notes. So we have no concern on those. But it doesn't help the junior notes, so the single Bs and the double Bs, and we have quite a few of those also on negative outlook. However, what we've seen is now that the cycle has turned, quite a few deals are getting called after all. So I think that has accelerated, and we believe that will continue. So before some of those single Bs are really ending up in the tail end, we believe that the deals will be called.
Good. Now, moving on, maybe from the traditional balance sheet CLOs to product innovations, are you seeing any?
Well, there's a lot of talk about a mid-market CLO in Europe. That would be a first. It's an active market in the US, but we have not seen one in Europe. Perhaps these middle market CLOs have been done on the private side, but we have not seen a public one. Arrangers, managers have been showing interest in such a structure, and we may perhaps by the end of the year have seen the first one, which is likely going to be a static transaction. The one concern around a static CLO and these mid-market loans or direct lending loans would be that there's a long enough tail in the structure to basically handle a continued amend and extend activity should the credit cycle turn. Possibly that tail needs to be longer than in a BSL CLO.
Okay. Now moving back to BSL CLOs, we have to make one point. We might see a record issuance here with 2024. It's not clear yet, but definitely very strong issuance. What are your expectations concerning issuance going in 2025? Can this be repeated?
I'm terribly bad in projecting, so I would have been the last person to expect that for 2024, another record year beating 21. We have not done that yet, but it looks increasingly likely that by the end of the year, the issuance volume for 24 will exceed 21. And I guess kind of it's a demand-driven situation. So CLOs have proved their performance again in the last 2 years. They pay an attractive coupon, and possibly we have also seen that CLO tranches remain liquid, as we have seen during the LTI crisis following the mini budget here. SF in general has remained liquid while other sectors have lost liquidity. So those factors together make them an attractive product to investors, and investor demand has certainly driven the issuance this year. The bigger question is, where did all the assets come from? Because we hardly saw any LBOs given the high interest rate environment. But I think in that case, a lot of collateral came from existing CLOs that reduced their AUM and that fed the new CLO formation, especially after 2 years of no resets and refis. Now, for next year, I can't see that really changing. We still have a lot of CLO funds out of reinvestment. They have to be refinanced, and so there will be a continued supply of collateral for new CLO formation. Plus, on top of that, the interest rate environment has turned, so I think it looks also more positive on the LBO side.
Okay, so quite a positive outlook again. Thank you for your insights, and thank you for joining us today. If you have any questions or would like to continue the discussion, please contact us using the address on the screen. Thanks for watching.